Hi everyone, welcome back to Channel Name, where we break down hot stocks in the energy sector. Today we're diving deep into GE Vernova Inc., GEV, the energy spin-off from General Electric that's been on fire since its April 2024 IPO. Up over 300% already, trading around $625 as of September 2025. But the big question, can it reach $1,000? We'll cover pros and cons, competitors, margins, debt, dividends, future plans, and how it stacks up against the S&P 500. Stick around, this could be your next power play. Let's get started. First, the pros. GE Vernova is perfectly positioned for the global energy transition. With a massive backlog over $100 billion, up $5 billion just in Q2 2025, they're seeing double-digit revenue growth at 11 to 18% year over year. Margins are expanding too, thanks to high-margin services making up 65% of that backlog. Think renewables, gas power, and grid solutions for AI data centers and EVs. Government subsidies like the U.S. Inflation Reduction Act are a huge tailwind. Plus, low debt, zero long-term, and $8 billion in cash means they're flexible for growth. But cons? It's trading at a sky-high PE of 144, which some analysts call overpriced. Net margins are still modest at 3.16%, and offshore wind has been a headache with supply chain issues. As a young company post-spin-off, integration risks linger, and energy price volatility could bite. Moving to competitors, GE Vernova leads in hybrid gas renewable tech against giants like Siemens Energy, Vestas Wind, and Bloom Energy. They hold 20% plus market share in power equipment, outpacing rivals' 5 to 7% growth with their 11%. Profit margins, current net is 3.16%, gross 20%, operating 5.9%. But here's the good news. From 2024's 11.7% gross to 17.4% last year, and up another 260 basis points in 2025. Annually, they're adding 5 points via efficiency, better than Siemens' flat 4%. Rivals are close, but GEV's backlog gives it an edge. Debt situation, super solid. No long-term debt, total liabilities, $41 billion, mostly operational, covered by strong free cash flow. They can easily service everything. Fitch rates them BBB with a positive outlook. Side incomes, mostly from services and carbon consulting, adding visibility without major balance sheet strain. In fact, it boosts FCF and margins by 3 points. Since IPO, investors are up 300%, way better than the S&P's 17%. Looking ahead, for 2030, $600 million in U.S. plants, 150 gigawatts capacity add, and nuclear like BWRX 300. By 2040 to 2050, carbon capture at 95% efficiency and EV-ready grids. Political wins, renewables, subsidies profit them big. But risks? Subsidy cuts or inflation could hurt, plus social issues like supply chain labor, extreme weather, a wild card for grids. Dividends, new kid, started December 2024 at 25 cents quarterly, $1 annual, 0.17% yield. No increases yet, and not an aristocrat, needs 25 years. Short-term, 92% YTD versus S&P 17%. Long-term since IPO, 190 to 300% versus S&P 17% and MSCI World 15%. It's crushing global indices on energy boom. So, $1,000? Analyst targets top at $760, average $600, 20% upside short-term, long-term, possible by 2030 with 20% growth, but high valuation caps it. Buy if you believe in energy transition, hold for volatility. What do you think? Comment below, subscribe for more analyses. See you next time.